Hello and welcome to a brand new show on ET Now. What makes an unknown investor an unforgettable brand? What is the secret sauce for smart investing that differentiates a great business from the mediocre ones? In this special and one of its kind series, we shall talk about some of the legends from the world of investing. So as we talk, we walk you through the process of their original thinking, how have they acted in the moment of fear and despair, and the risk management framework they used, which led them to the path of huge wealth creation. This is Priyanka Uppal, and joining me in this special conversation is Nikunj Dalmia, Editor-in-Chief ET Now, who has an extremely rich experience of knowing about these personalities and even meeting few of them in person. Nikunj, thank you so much. This series is your brainchild. But before we discuss about these market gurus, we need to first put a perspective for our viewers. What are we trying to establish in this show?
Investing is simple, yet it sounds very complicated. My favorite line in the world of investing always has been, when you're investing, you're buying future purchasing power. You should have the vision to see, courage to buy, and the patience to hold. In this series, we would be showcasing and we would be telling you really the insights of what makes and what really takes to be a legendary investor. Investing is perhaps based on a simple theory, which is you're buying the future business at a fair price. Original thinkers have one thing in common, which is that they want to maximize by buying good businesses and they want to hold it for a long time. But each original investor has a very different template, a style, a formula, and a thought process. And in this series, we would be showcasing some of the real pedestal investors. Good old Vijay Kedia. Well, from songs to his art of smile, we'll talk about it. Radha Kishan Damani, the legend himself. A man who literally needs no introduction. If a pantheon of great investors has to be made anywhere in the world, Radha Kishan Damani would always find his name right on the pedestal. I want to remind our viewers that Rakesh Jhunjhunwala used to call him his market guru. Rakesh Jhunjhunwala himself, what makes him India's most admired and India's most loved investor? What did he do so special? Why was he so bullish? And what was so unique about his approach that not only he was a great investor, but he was a master trader? How did he connect the dots? We also would be showcasing another very favorite investor of mine, and I must admit that I've learned a lot from him, Kalpraj Dharmishi. Very unique in terms of his ability to identify the next big thing. How has he done risk management in today's time when everything is dominated by AI? And then Manish Chokhane. While you've seen him on the show before, but his ability to again look at the macro, connect the dots, define the true value of value, and then hold on to it for years, I think is quite unique. So I'm really hoping that in this series, when we would be getting into when we'll take a deep dive and we'll examine the thought process, the portfolio, real life examples, our viewers will be able to adapt, apply, and importantly, learn.
All right, so let's dive deep. We are starting this show with a very special name, Pulak Prasad. But who is Pulak Prasad? One of the respected market guru. Founder of Nalanda Capital, who has a net worth of approximately 27,000 crore. His fund has been consistently generating 19% of return over the last 16 years. Nikunj, it is very imperative, very important to know your circle of competence and the art of saying no. And Pulak knows exactly when to say no. No matter how tempting the situation may be, he uses certain filters to make decisions. What are those filters?
So Priyanka, Pulak is someone who's a student of markets and a practitioner of history. Pulak simply follows a very simple concept that rule number one, it's a rule from Buffett, you should not lose money. Rule number two, you should not forget rule number one. So Pulak in a sense has a big filter. Imagine, I want our viewers to imagine there is a filter, a funnel in which you have a filter. And Pulak uses a strong filter to say no. When I say no, the ability of big investors to say no to whatever comes their way, I think is far more important in their ability to say yes. And history has taught us that if you are able to reject the companies which are outside your circle of competence, which is businesses which you understand and business which you don't understand, and as long as you know that what you understand and what you don't understand, you essentially are in a position to reject those ideas. Also, Pulak has said that yes, when you are saying no to almost everything that is coming your way, you may be missing out on what could have been a multi-bagger. But his ability to say yes to what he understands gives him this edge. And there is a data point which he has shared, and we'll put it out, which is that if you make far less mistakes and if you stick to what you understand, your ability to generate superior returns on a longer period of time, I guess, is far greater. Because when you understand a business which is part of your COC, which is circle of competence, you can really ride through the ups and downs. You know how to value the business. You know that as the disruptive forces of competition, disruptive forces of macro, disruptive forces of globalization will hit the business of that company, on what end that company in a sense would come. What looks like a connected world today may be a disjointed world, and COVID has taught us that world can change, but as long as you understand that business, which will only come with the knowledge and your ability to understand the competence of circle, you will take few, but you will take less bets. So your ability to say no gives you this edge, which Pulak has said, where you will be able to filter out what you don't know. Occasionally you will miss out some names. Occasionally you may miss out some multi-baggers. But what you buy with your understanding will give you far greater edge than unnecessary diversification. It's very simple. Pulak applies it, and Pulak has always said that, look, he's taken a lot of cues from Warren Buffett. Warren Buffett has always said that we don't believe in buying stocks. We believe in buying businesses.
Sure.
We like to be partners with great managers. And I think that is what Pulak has, in a sense, very clearly articulated in his book. As a policy, Nalanda does not talk to media. So when we structured the show, this was perhaps based on the book.
Yes.
And also some private conversations we've had with folks who know him and brokers and firms who've serviced Nalanda as a firm. They believe in owning business permanently, which is that if it's a business, we would like to own or become a shareholder of the business, in this case partner, permanently. We are not equity investors, which is equity investors, they time the market, they are looking at owning an asset class, but in this case Pulak has said that we try to own the business as a business owner. Then the importance of high quality at a fair price. And this is something which I think over the years I think that has the definition of quality and the definition of price has changed. There's a time when Buffett used to follow what could be called as the Benjamin Graham kind of an investing, which is that buy a company which is below its intrinsic value. But I guess Pulak follows what Buffett has started following after he met Manjar, which is that buy a company at a fair price, but buy a high quality business when there is blood on the street. And there are empirical examples of that how does he define quality and how does he define fair price. Some pointers are there on the screen.
All right, and now let's understand what is the filter criteria he uses and one of the main yardstick he uses when he has to select businesses.
Okay, I think it's the most important yardstick, and again this is a thought which Pulak has articulated in his book, where he speaks about evolution and where he speaks about evolution which could become a benchmark to understand the future. Return ROCE is a benchmark, and to simplify it for our viewers, it is the rate at which the company is generating return. If you look at the evolution, Pulak has said that the reason why species survive millions of years of evolution and they become dominant is because they are not really able to adapt with the change which is happening in the natural surroundings. There are a lot of examples of how a lot of species have become
Dinosaur he's been drawn
exactly,
very
dinosaur,
little.
dodo bird, there are a lot of examples. But the ones who've survived, they have a unique ability. when it comes to dealing with nature and the adaptability. Similarly, companies will always go through ups and downs. There are global factors, 9/11, 2008, COVID. But companies which generate superior return, and there's a benchmark of superior return which he has used, if the companies are generating that superior return and if they have a track record where they've survived a COVID storm, where they've surprised, where they have gone through the pain of demonetization, where they've gone through taper tantrum, GFC crisis, those companies can really adapt. So just like a species will only survive as long as they are able to adapt to the change of the natural surroundings, companies which generate superior return equity or return ratios will survive when the cycle goes through ups and downs. When you have a superior return on capital, that means in a good time you are making returns which are higher than the industry or the peer, and in bad time it is really the structure or the nature of the business or the moat you have in the business will ensure that in a downturn the cushion in a sense is there in a downfall. So Priyanka, I mean these are classic stocks which today are called as some of the best compounding industries. In the history of Indian capital markets, if I look at the last 20 years, Page Industries in a sense has been one of the biggest wealth creator. And the reason why Page Industries has managed to create this kind of an wealth is largely because of its ability to have high return ratios, its ability to have that advantage on supply chain, and its ability to really expand the market share, and at a time when the unorganized economy is becoming organized economy, and we've seen that the per capita income is moving, and Innerwear was a category which was dominated by the unorganized market, now is dominated by the organized branded players. So his ability to, let's say, identify Page Industries at a time of crisis, which is then world was just coming out of 2008 crisis, I think gives him this advantage to buy a good business when there is a despair on the world.
Correct.
Once you buy a good business, you pretty much ride the business cycle. The definition of a good business is a company which generates superior returns, where the size of the growth is large, and where there is a natural tailwind which is coming because of the big trends in the economy. So Page in a sense really fits the culture, the template, and the thought what Nalanda actually adopts. And then he believes in, once you see an opportunity, Pulak has followed a simple mantra that buy as much as you can, which is that you take large bets, disproportionate bets, buy them during the period of bad time, and then really ride it for multiple years. Like we said at the beginning, he believes in owning stocks for
permanently.
Not days, not weeks, but for years. So this graphic will just come up on your screen, which is just think about it. Havells bought in 2007, Page Industries bought in 2008, Mindtree bought in 2009, Supreme Industries bought in 2010, DB Corp bought in July 2012, holding on to it for over 12 years now. And his portfolio has not changed. I mean, at this point in time, I would also urge our viewers, and the producer will fire his portfolio with this lovely graph which talks about his average holding period. Yeah, so the line which he uses, and I think our viewers should take notice of it, we are not lazy, but we are
very lazy.
Yeah. And that is the trick of investing. That investing is not about activity. Newton का third law है ना Priyanka?
Yes.
Newton के third law में है, if you are, for every action there is an opposite reaction. The more you trade, the more you churn, the more impact it will have in your portfolio. But once you buy and hold a good business, if you bought it at a good price, when there's distress on the street, and then you let the power of business and power of compounding do magic for you. It's very simple. All it applies is a thought process. It acquires understanding of what you know, and your ability to say, okay, I may miss 100 multi-baggers, but I will identify 2 multi-baggers.
Sure.
And those 2 multi-baggers are good enough to take care of what my current need is, and where I see the power of compounding will work for me. One of the most underappreciated fact that I think Pulak and all investors they adopt, and I think this in a sense is the ultimate gospel, is the power of compounding.
Okay.
We've discussed this in the past, but I promise to bring this point out on every show. If you multiply your capital, or if a stock appreciates for 20% for 10 years, it's 10x. But if it multiplies for 20 years, it is an 100x. All you need to figure out that which business can multiply for 20% for 20 years and what are the characteristics which are required.
Right.
So evolution has taught that there are certain basic characteristics which are required for a species to survive. Similarly, market history has taught us that what are the characteristics which are required for a good company to survive, whether it is based on return on equity, whether it is built on some other factors which we will discuss.
Sure.
And as long as those filters are put into place, Pulak is happy to buy them when there is panic in the market, and then happy to ride them. It's very simple. We are making,
Yes.
we are putting a template here. But trust me, that is the magic of investing.
Yes.
It looks complicated. It's very simple.
Pulak has very interestingly drawn a parallel between how companies operate and how species have evolved over the period of time. Now, just like he's given an example about dinosaurs. In fact, it is very imperative to have a very clear list of do's and don'ts. And Pulak also has a very clear list of what he avoids. Let's understand this.
Okay, so avoid crooks. Simple. Ek baar chor, baar chor. Nothing changes and nothing will change. That's Pulak's idea, that if you are a management who has not taken care of minority shareholders in the past, he will not bet in them, and as a result, if a management has a poor track record on governance or on capital allocation, he will not invest in that company. Second, turnaround stories. Turnaround story means ये company में होने वाला है, ये हो सकता है. So do not buy the future based on storytelling and assumptions. Turnarounds may happen, turnarounds may not happen. Stay away from companies which are M&A kings. There are a lot of companies which essentially have this binge to grow by acquiring growth. That's M&A. Market history has told us that 8 out of 10 M&As globally have failed. Sure. And the 2 which they have succeeded, it's very hard to understand whether they will succeed or not. And I'll give this very classic example. Motherson Sumi, I think, has championed the art of M&As because they understand the capital allocation. But if you look at a lot of other corporate groups where they've really gone on some kind of a binge in terms of M&A, those M&As have not really translated into what the real attempt was. So avoid companies which essentially are M&A junkies, which is they keep on doing M&As to grow their balance sheet, because ultimately you will move away from the businesses. Then Pulak has always avoided PSUs. Now you may argue back and say that, "Arey, is boom mein kya hua?"
Governance issues.
That's the view of a management. I don't agree with it.
What he
Personally,
cited,
I don't
yeah.
agree with it. So what we are sharing here are views of Pulak Prasad. So he has avoided PSUs, which means that he pretty much has missed on this entire bull market in
From
PSU.
PSU space, yeah.
So the temptation, I think, for a great manager or a great, investor is that you know what you understand and you know what you don't understand. Markets may do strange things in the short term, but you should not have envy or you should not have FOMO that, okay, I don't understand PSUs, but PSUs are in bull run, others have made money, I will come back. That is the discipline. What will differentiate you ultimately is going to be skill and risk management. In a good market, it's not how much you make, but in a bad market, how much you save. And as long as you don't understand, so Pulak has made it very clear that, look, I don't understand certain PSU companies, so I will not buy them. Which means he may have missed out on the bull run, but that's the way he's okay with it. Similarly, he does not buy companies which essentially are conglomerates, which means companies which have multiple businesses, he avoids them. MNCs.
So we're saying that Nalanda does not believe in being lazy, rather being very lazy. Does this mean that they would never sell a business? Or when do they know that this is the good time to sell?
Yeah, see, when you're managing public money, you have to sell. So the factors which are used, which they've used where they sell, is that within the original thought process it changes. Now, when you've invested in a good company, you don't know what the bull market could do, which is that the P multiple of 20 could become 50 or 50 could become 150 or 150 could become 300. So they're not in the business of judging where the stock is going to go, but they are in the business of perhaps monitoring that the thought process which they had applied when they had invested in that company, has that thought process changed? And I'll look at 2 classic examples here. Classic example number 1, Tharocare, which was part of Nalanda's core portfolio. Tharocare promoter Mr. Velumani, they decided to sell their business to PharmEasy. And the very next moment when this deal went through, Nalanda decided to exit their holding in Tharocare. It had the lowest cost advantage, and it was a very efficient diagnostic stock which knew how to manage scale, and it was throwing up a lot of cash, and that business was growing at a growth rate which in a sense was enviable. Now post the merger with PharmEasy, of course that whole management and the business thesis of Thyrocare got changed. So once your thesis and the reason why you bought, if that changes, well, that's the time they've exited the stock completely and totally and pura bechte hain. They don't then say I will sell 50%, I will buy at lower level. No, if my thesis is broken, Buffett says I'm going to exit. For example, Buffett invested in airline stocks, his thesis was broken, he decided to exit airline stocks completely. Another example is TCNS Clothing, fantastic business, but the business was acquired by Aditya Birla Fashion Retail. The shareholders of TCNS Clothing, they were getting a share swap. In that share swap, they were getting shares of Aditya Birla Fashion Retail, which is a completely different kettle of fish, different ownership, different brands, debt on the balance sheet. So that's the time Nalanda decided to exit it. Now these two decisions on whether the management will own or sell is a function of individual managers. But for Pulak and his fund, when the decision to buy was based on a filter criteria, if that filter changed, that automatically meant that he no longer would remain invested in that company or in that business.
So Nikunj, one of the argument in this entire conversation can be that Nalanda always wants to buy at a fair price. They want to buy, they invest only when the valuation is not high. But why not to sell when the valuation is high?
You know, that's a great point. I mean, when you buy a business, you're buying at a fair price. Because when you're buying the business at a fair price, you are, perhaps the most important yardstick is margin of safety. Margin of safety is nothing else but a function that if you get your thesis wrong, how much money can you lose? So that's the reason why all big investors historically, they wait for bad market conditions, or they wait for what we say blood on the street or a macro sell-off when you get great entry points, because your margin of safety is there. Investing is nothing else but it is like buying gold at the price of silver or silver at the price of bronze. In COVID, well, you got gold at the price of bronze. Rarely that happens. That happens once in 10 years. But once you've acquired a good business, when do you sell? And over the years, what I think Pulak has mentioned and what we've seen with his investment style is that he's a big proponent that great businesses can grow. Great businesses can surprise you. Great businesses will continue to prosper because they have a reason why they are great businesses. And when you are in a growing economy like India, if you are in a great business, and as long as valuations are not very wild, Nalanda as a fund, it likes to ride the momentum. Because in an economy like India, when the economy is expanding, extraordinary things are happening. Which means you do not want to limit the upside, because a great businesses can become an extraordinary businesses, and an extraordinary business actually can become like a immortal business. So if you buy a good small cap, if the business is growing, it could become a mid cap, it could become a large cap. Now that's the potential of the business, and the potential of the business is a function of the business you are in and the return ratios you have. So I think one of the most unique things here, which I think our viewers need to understand from Pulak's thought process, is that you do not want to, you want to limit your downside, but you do not want to cap your upside. And that's what I think great investors have done. They are in a hurry to buy when bargains are there, and they buy a lot, but they are no hurry to sell, because if you hold on to something big, special, and a great business, it can really surprise you. A classic example here is, look at profits of Titan, look at profits of Bajaj Finance, look at profits of HDFC Bank. Seldom Mr. Parekh or seldom Mr. Tata would have thought that this really could be the potential of some of these great businesses. I mean, look at the evolution of Titan. From being a watch company to a jewelry company, now it is moving into eyewear and it is moving into perfumes. That's how great businesses they evolve. That's how HDFC Bank is evolved. So you really want to ride the journey of the evolution of this great business. So, a lot of times to break it up, Ramesh Damani also taught me the same thing. Bola bhai, wo double ho gaya to becho mat. Business kya double ho sakta hai, triple ho sakta hai, to better ho.
Absolutely, Nikunj. Thank you so much for decoding the entire framework for us, for our viewers. So when we have such spectacular success stories, why reinvent the wheel? Easier practice could be implementing the same model, which is proven, tested, and has led to wealth creation. Thank you so much, Nikunj, for decoding the investing framework of Pulak Prasad. And in our next episode, we shall discuss another Badshah of BSE who knows how to get his bets right. Thank you so much for watching.
If you like this video, then like, share and subscribe to ET Now.